Money is not just numbers. It's not spreadsheets. It's not formulas, charts, or forecasts. Money is behavior. And behavior is deeply personal. Two people can earn the same income, live in the same city, invest in the same market, and end up with completely different financial lives. Why? Because money decisions are not made in classrooms. They're made in kitchens, in childhood homes, in moments of fear, pride, envy, and hope. This is the central idea of the psychology of money. We don't all experience the same financial reality, even when the numbers look identical. Before we go any further, take a moment to follow Success Resources Books Insights. This channel exists to help you understand money, not just intellectually, but emotionally and behaviorally, so it serves your life, not controls it. Morgan Housel is not a traditional finance guru. He doesn't shout predictions. He doesn't sell shortcuts. He doesn't promise overnight wealth. Instead, he studies people. As a longtime financial writer and former columnist for the Wall Street Journal, Morgan noticed something strange. The biggest financial successes were rarely the smartest people in the room, and the biggest financial failures were often highly intelligent, well-educated professionals. The difference wasn't IQ, it was how they behaved under uncertainty. That observation became The Psychology of Money, a book not about how money should work, but about how money actually works in real human lives. Imagine two investors. One grew up in the Great Depression. The other grew up during a long bull market. The first fears risk. The second assumes markets always recover. Neither is stupid. Both are shaped by experience. Morgan explains that your view of money is formed by events you did not choose, but those views go on to influence decisions that shape your entire future. This is why financial advice often fails. It assumes one universal truth. But money is contextual. What feels safe to one person feels reckless to another. What feels patient to one feels slow to someone else. Understanding this is the first step toward financial peace. We love simple narratives. We want to believe success is earned purely through skill, and failure is caused purely by mistakes. Reality is messier. Luck and risk are always present, but invisible. Morgan tells the story of two men born in the same year. One becomes the most successful investor of all time, the other loses everything. Both were intelligent. Both worked hard. The difference was not just what they did, but when they did it. Timing matters. Context matters. Randomness matters. This doesn't mean effort is useless. It means humility is essential. The smartest investors respect luck. They don't confuse favorable outcomes with personal brilliance. If you believe success is only about being smarter, you'll underestimate risk. If you believe failure is only about being careless, you'll underestimate resilience. The psychology of money teaches a quieter truth. Financial success is about doing reasonable things consistently for a long time. Not heroic decisions, not perfect timing, not constant action. Just behavior you can stick with. Morgan's first rule of money is simple. You don't need to be brilliant. You just need to survive. Compounding only works if you stay in the game. The biggest threat to wealth is not low returns. It's panic, ego, overconfidence, impatience. Most fortunes are lost not by one bad decision, but by a series of emotional reactions to uncertainty. Staying calm is a financial skill. As this journey unfolds, you'll notice something important. This book doesn't tell you what to invest in. It teaches you how to think so you can make decisions that align with your life. In the next segment, we'll explore why being reasonable beats being rational, and why the calm investor often outperforms the clever one. In theory, money should be simple. You calculate, you optimize, you choose the best option. That's how textbooks describe finance: cold, logical, rational. But real life doesn't work that way. Real people don't wake up as spreadsheets. They wake up as humans, carrying fear, hope, memory, pride, insecurity, and desire. And those emotions walk with them into every financial decision they make. This is why reasonable decisions beat rational ones. A rational decision is one that looks perfect on paper. It maximizes expected return. It minimizes inefficiency. It assumes calm behavior under pressure. But pressure is exactly when humans stop being rational. Morgan Housel noticed something critical. The best financial strategy in the world is useless if you can't stick with it. A portfolio that earns 8% but keeps you awake at night is worse than one that earns 5% and lets you sleep peacefully. Why? Because sleep leads to consistency. Consistency leads to compounding. And compounding, not brilliance, builds wealth. Reasonable decisions are not optimal. They are endurable. They are choices you can live with through uncertainty, volatility, boredom, and fear. Morgan explains that most people don't fail financially because they choose bad strategies. They fail because they abandon good strategies at the worst possible time. Markets fall, news turns negative, fear rises, and rational plans collapse under emotional pressure. Reasonable plans survive. There is a hidden gap in finance, the gap between what people should do and what they actually do. Academically, investors should buy low and sell high. Emotionally, most do the opposite. They chase performance. They flee pain. They react to headlines. Morgan calls this the behavior gap, and it explains why average investors underperform the very funds they invest in. Not because the funds are bad, but because human behavior sabotages compounding. The goal of money, then, is not perfection. It's alignment between your strategy and your psychology. Comfort is underrated. Being comfortable with your strategy gives you staying power. Staying power allows time to do its work. Morgan observed that many of history's most successful investors were not the smartest. They were the calmest. They avoided complexity. They embraced simplicity. They accepted that good enough consistently beats perfect occasionally. Comfort is not laziness. It's self-awareness. It's knowing what level of risk you can emotionally tolerate and designing your financial life around that truth. There is no single right way to build wealth. Some people build fortunes slowly. Some experience sudden success. Some take risks early. Some wait patiently. Morgan reminds us, different paths can lead to the same destination, and the same path can lead to different outcomes depending on timing and temperament. What matters is not copying someone else's strategy. What matters is finding one that fits you, because the best plan is the one you won't abandon. Reasonable investors accept 3 uncomfortable truths. You will never capture all the upside. You will experience periods of regret. You will sometimes look wrong before you are right. Trying to avoid these truths leads to overtrading, stress, and mistakes. Morgan argues that accepting imperfection is the price of long-term success. If you demand certainty, the market will punish you. If you accept uncertainty, the market will reward you over time. Morgan tells of 2 investors with identical strategies. One watches the market daily, the other checks once a year. The first panics during downturns and makes changes. The second stays the course. Years later, their results are vastly different, not because of intelligence, but because of temperament. The quiet investor wins. Complex strategies feel sophisticated. They promise control. But complexity increases emotional load. It creates more decisions. More decisions create more chances to panic. Morgan points out that simple strategies leave less room for emotional mistakes. Simplicity is not ignorance. It's risk management for your mind. Success in money is not about maximizing returns. It's about minimizing regret. A reasonable plan reduces the odds of decisions you'll wish you hadn't made. It protects you from yourself, which is the greatest financial risk you will ever face. Money does not reward intelligence alone. It rewards behavior. And the most powerful behavior is consistency. Reasonable beats rational because reasonable survives reality. Now that we understand why behavior matters more than math, the next question becomes unavoidable. If success isn't about brilliance, what is it about? If there is one force in finance more powerful than intelligence, more powerful than timing, more powerful than boldness, it is time. Time is the quiet partner behind every great fortune. It does not rush. It does not announce itself. It simply works, relentlessly, invisibly, patiently. Most people misunderstand compounding because they focus on speed. But compounding rewards duration, not velocity. You don't need extraordinary returns to build wealth. You need ordinary returns sustained for an extraordinary length of time. This is one of the most counterintuitive truths in money. Morgan points out that the most impressive fortunes in history were not built by the highest annual returns. They were built by people who stayed invested for decades, uninterrupted. The difference between someone who invests from age 25 to 65 and someone who invests from 35 to 65 is not 10 years of savings. It's 10 years of compounding, and those early years matter more than the later ones. Time does the heavy lifting. Your job is simply not to interrupt it. Humans love action. Action feels productive. Action feels responsible. But in investing, constant action is often destructive. Morgan observed that the most powerful financial move is often inaction. Doing nothing while others panic, react, and overcorrect. Compounding requires boredom. It requires the emotional strength to endure long stretches where nothing exciting happens. Most people can't tolerate that. They confuse movement with progress. They chase novelty and abandon patience. But patience is where wealth lives. Compounding doesn't need dramatic success. It thrives on small advantages applied consistently. A slightly higher savings rate, a slightly lower fee, a slightly longer time horizon, a slightly calmer temperament. Each seems insignificant in isolation. Together, over time, they become life-changing. Morgan emphasizes that success is rarely about one big decision. It's about thousands of small, boring, correct decisions, repeated. That repetition is what most people underestimate. Every time you sell out of fear, you reset the clock. Every time you abandon a plan, you break the chain. Compounding is fragile. It depends on continuity. Morgan explains that the greatest enemy of compounding is not volatility. It is impatience. Impatience demands results before time has had a chance to work. And when you interrupt compounding, you lose the exponential effect that only time can create. Many investors failed not because they made bad decisions, but because they couldn't endure uncertainty. They sold after crashes. They exited during fear. They re-entered after recovery. Too late. Morgan's lesson is simple but profound. You don't need to predict the future. You need to survive it. Survival means staying invested, staying calm, staying patient. Because compounding only works for those who remain. Volatility is not a flaw of markets. It is the fee you pay to access long-term returns. Morgan explains that volatility feels like punishment, but it's actually the mechanism that creates opportunity. If markets were smooth and predictable, returns would be lower. The discomfort is not a bug, it's the cost. Those who accept this reality stop fighting volatility. They plan around it, they expect it, they endure it, and in doing so, they earn the right to compound. Time filters out noise. Short-term outcomes are chaotic, random, emotional. Long-term outcomes reflect behavior, discipline, and resilience. Morgan urges people to extend their time horizon, not just financially, but psychologically. When you think in decades instead of days, panic loses its grip. Time reframes everything. One of the cruel truths of compounding is that losses hurt more than gains help. A 50% loss requires a 100% gain to recover. This asymmetry explains why protecting the downside is essential. Patience doesn't mean recklessness. It means avoiding decisions that permanently remove you from the game. Morgan emphasizes that endurance is the real advantage. Not brilliance, not boldness. Endurance. The calm investor benefits from everyone else's anxiety. When others sell in fear, opportunities appear. When others chase hype, prices inflate. Calmness is not passivity. It is strategic restraint. Morgan notes that history rewards those who can remain rational when emotions run high. Calmness allows compounding to continue uninterrupted. Long-term thinking changes how you experience the present. Short-term thinking magnifies every fluctuation. Long-term thinking absorbs them. Morgan reminds us that most of the market's gains occur in short bursts surrounded by long periods of boredom. Miss those bursts, and long-term returns collapse. And those bursts are often missed by people who leave during fear. Compounding is not about being right. It's about staying. It rewards patience, humility, and endurance. Time is the greatest asset you will ever own, if you let it work. If compounding is the engine of wealth, the next question becomes deeply human. How much is enough? There is a word that quietly determines whether money brings peace or pain. That word is enough. Not earning enough, not saving enough, not investing enough. Just enough. Most financial stress does not come from scarcity. It comes from comparison without boundaries, from chasing a finish line that keeps moving, from never deciding what enough actually means. Morgan Housel discovered that defining enough is one of the most powerful and most neglected skills in finance. Human ambition is limitless. That is both our greatest strength and our greatest vulnerability. Once a goal is reached, a new one appears. Once a lifestyle is achieved, a higher one beckons. Once success arrives, comparison follows. The danger is subtle. More income creates more desire. More desire creates more risk. More risk increases the chance of losing what you already have. Morgan observed that many financial disasters are not caused by need. They are caused by the refusal to stop. People who already had enough took one risk too many. Not to survive, not to build, but to prove something. Saying enough does not mean lacking ambition. It means placing a ceiling on risk. When you know what enough looks like, you stop gambling with things that matter: your time, your family, your reputation, your peace of mind. Enough gives you leverage. It allows you to walk away from deals that threaten your stability. It protects you from chasing returns that come with unacceptable risk. Morgan writes that the hardest financial skill is not earning more. It is getting the goalposts to stop moving. Money is deeply social. We don't measure success in isolation. We measure it against neighbors, colleagues, peers, and strangers online. The problem is that we compare our entire lives to someone else's highlight reel. Morgan explains that envy is the only financial sin you can never satisfy. No matter how much you gain, someone else will always have more. Comparison without context is poison. You never see the risks others took. You never see the stress they carry. You never see what they sacrificed to get there. When you chase someone else's definition of success, you inherit someone else's risks. The concept of enough is not philosophical. It's practical. Knowing you're enough helps you answer hard questions. How much risk am I willing to take? How volatile can my income be? How much time do I want to trade for money? What am I unwilling to sacrifice? Without answers, ambition becomes reckless. With answers, ambition becomes focused. Morgan notes that the most successful long-term investors are not those who chase the highest returns. They are those who avoided ruin. Enough keeps you in the game. Here is the paradox Morgan highlights. People who are content with what they have often end up with more than those who are never satisfied. Why? Because contentment reduces desperation, and desperation leads to bad decisions. When you are not desperate, you can be patient. When you are patient, you can compound. When you compound, wealth grows quietly. Contentment is not complacency. It is emotional stability, a foundation for rational behavior. Ambition builds, greed destroys. The line between them is thin, invisible, and personal. Morgan tells stories of people who crossed that line without noticing, who already had financial independence but chased one last deal, one more year, one more surge, and lost everything. Enough would have saved them. There are things money cannot buy back. Lost health, broken relationships, time with children, peace of mind, integrity. Morgan argues that protecting these is more important than maximizing returns. If more money costs you what you value most, it is not worth it, no matter how impressive the numbers look. Enough is how you draw that boundary. Enough is deeply personal. It depends on values, not averages. It depends on priorities, not benchmarks. It depends on the life you want to live, not the lifestyle others display. Morgan encourages readers to ask, what does a good day look like? How much autonomy do I want over my time? What level of stress am I willing to tolerate? What am I optimizing for? Status, freedom, or peace? These answers shape your financial decisions more than any formula ever will. One of Morgan's most important insights is this: true wealth is invisible. It's the money not spent, the risk not taken, the freedom preserved. Spending money is easy to show. Saving money is quiet. But quiet choices create loud freedom over time. Enough allows you to build that invisible wealth, the kind that buys options, not objects. When you define enough, anxiety loosens its grip. You stop racing, you stop proving, you stop reacting. You begin choosing. Enough gives you the confidence to say no, and the clarity to say yes when it matters. Happiness is not the result of having more. It is the result of wanting less. And the ability to want less is the ultimate form of wealth. If these ideas are reshaping how you think about money, follow Success Resources. Books Insights, where timeless wisdom meets real life and learning becomes a long-term advantage. Now that we've explored the power of enough, the next question becomes practical and urgent. How do you protect yourself from uncertainty? In Part 2, we'll explore margin of safety, why room for error is the most underrated financial advantage, and how building buffers can save your financial life when the unexpected arrives. This was The Psychology of Money by Morgan Housel, narrated by SR Books Insights. This is more than mindset. It's a mission. Keep seeking, keep growing, keep giving. And together, let's make the world rich again.